Hey traders, this is Blake Morrow with Forex Analytics, and you're listening to the week ahead video for November 27, 2022. I hope you guys and gals have had a great few days, especially those of you in the US. I hope you had a nice long weekend celebrating Thanksgiving. For the rest of you that weren't, I hope you're enjoying the World Cup if you're a football fan. Anyway, it's been actually a really busy week, despite it being a short week. So we're going to talk about all of that. We're going to talk about what's coming up this next week, especially with the jobs report, the non-farm payroll, and see how the Forex market and the rest of the market's going to react. So before I get into that, I just want to say thank you guys and gals for joining in today. I do appreciate it. Remember, check out Forex Analytics. It's only $1 for 10 days. You can be involved in our community, so check it out. Now, I'm going to go over to the dashboard really quick, just letting you all know that here's like the data flash, just some different tools that are included. This one actually populates as soon as that data comes out, so you can have a quick notification on if the data is going to be a beat or it's below expectations. It's about as fast as Bloomberg. It's pretty awesome. It's included with Forex Analytics, but you got a lot of tools here like Live Squawk, scrolling live feed. You've got a lot of analysis in the markets that you can go through and look at from Elliott Wave, harmonic, basic technical, macro analysis of 30 different instruments. So make sure you check it out. Again, it's $1 for 10 days. Check it out. I'm going to go into the basic technical analysis just in live charts, so this way I can draw on them. So let's start with kind of what happened last week. Now, speaking of what happened last week, I think one of the developments that we were discussing, and let's go take a look at the dollar index, is on the dollar index. We were looking for a rally and then a pullback, and we did. We got a rally back to the underside of this broken trend line here, and you can see we failed there. And because we failed there, and we're just sitting above the 200-day moving average, shows you how vitally important that 200-day moving average is in the dollar index. Now, you could actually look on a little bit shorter time frame and also identify that we are setting up a bear flag pattern, right? Now, going into the beginning of this next week, I'm not sure if we're going to see a breakdown of the dollar index. However, there is something that actually is leading me to believe that it could at least start. And if you remember our conversations last week about the S&P, we talked about how it could continue to go up towards the 200-day moving average. We were getting very close to the 200-day moving average, but also very important, what I consider channel resistance. This channel resistance has been significant all year since the beginning of the year. Now, let me delete this line. We don't need that for right now. That's the head and shoulder pattern target area, which I still believe that we can see. But in the S&P, as we approach this 200-day moving average and this channel resistance that you see here, I think this is going to become very significant for the market. So my opinion is, as we approach 4,100, is we're going to make our way lower. Now, the reason why I'm saying that is because in the coming weeks, based on this week's data, especially this week's data with the jobs report on Friday, December 2nd. So remember that's going to be the key or marquee event of the week. If that data comes in strong once again, the market is going to believe that the Fed is going to continue to stay hawkish. Now, we got a little bit of mixed signals this week with the FOMC meeting minutes suggesting that they may have peaked, or we may be seeing peak rates soon, and that has allowed for the equity markets to continue to rally, and that's what actually propelled that US dollar sell-off there at the end of the week. So on Wednesday, you can see Wednesday, Thursday, Friday, just the sell-off and then consolidation after the FOMC meeting minutes and during the Thanksgiving holiday week. The reason why I point all this out is because if right now the market's leaning into being very bullish, you got the stock market chasing that 200-day moving average. You got equity market traders, institutional traders that are trading on the long side because they're trying to play catch up on a pretty what's chalking up to be a very dismal year in the equity markets. So you got everybody trying to play catch up, make sure they're invested, trying to squeeze the last bit of performance out of the market that they can. The problem is if the Fed, if the market starts to get a little nervous, if the data continues to be strong, that means the market might become a little nervous about what the Fed may deliver mid-month in December. they might continue to be more hawkish. And that, in my opinion, is what is going to potentially create a downdraft in the equity market. So we got to start preparing for that this week and next week as well. So these next couple weeks, I think it's going to be very critical as that S&P is near 4,100. I want to also show you something else while we're talking about equities. I want to show you the Nasdaq. Nasdaq still continues to underperform, and the reason why the Nasdaq continues to underperform, especially relative to the S&P, is because these are growth stocks. These are technology stocks. They're stocks, it's the technology index, if you will. They're stocks that tend to do better in a more favorable growth period in the economy. And right now, we're not seeing that. A lot of people believe that we are in a recession, or one is coming up. And so the reason why I say that is because if the Nasdaq was outperforming the equity markets, the S&P, I'd be more apt to be bullish risk. But right now I'm a little nervous. And you can see the Dow 30 is outperforming. And some of those big cap names, those companies that actually make money, those are outperforming. And that doesn't surprise me in this type of environment. The market seeks out companies that are actually making money versus ones that they think they might make more money in the future. But one thing I do want to note about the Dow here is, even though we're hitting new highs, we're hitting new trend highs here, you can see how the relative strength is really slightly divergent. And so as that divergence takes place, you have to be a little careful chasing risk up here. That's why I think the S&P is at risk of a pullback, as we approach that 4,100 level. But let's see how the market reacts at the 200-day moving average, which I'm assuming is going to be tested this week. And if that is the case, that dollar index may see some further pressure, whether you're talking about the 200-day moving average, maybe down to the 104.50, which you can see this very, very key, very, very key, I didn't mean to move that, horizontal support you can see right here. I think that is going to be very critical for the dollar index as we go into this week. One of the other technical reasons why this is going to be a big deal for the dollar is because at this point in time, the dollar is not making lower lows longer term. If we get below this support, we get below, that low right here, which is basically 104.60, 104.55, somewhere around there. We start getting below those levels. That means technically the dollar is making lower lows, and that sets up for a longer term. Even if we get a bounce, it's a longer term reversal for a downtrend in the dollar index. So that's something we should be very clear about. Now, before I leave the dollar, I do want to talk about bonds. And I want to talk about the 30-year bond market because, you got the 30-year, you got your 10-year, you got obviously the shorter dated maturities as well. But I'm going to pay attention a little bit to the 30-year because the 30-year is trying to make it's trying to make a move. And you can see we're going to be approaching some really critical resistance at a big breakdown point around the 130.30 level, 131 level in the 30-year bond market. Now, in the event that bonds actually break that resistance, that means yields are going to come down. And if yields are coming down, that tends to weigh on the dollar. But if this level can hold in the 30-year, and if you go to the 10-year, very similar. If this level can hold, it's around the 114. If that level can hold, that is a risk of a sell-off in the bond market, a rally in the dollar, and that could be one thing that causes the dollar to reverse, if we hit a new low or if we hold the 200-day moving average. So I want you guys and gals to pay attention to the bond market if we see the dollar actually break down, because you look at it technically, you look at the dollar, we got a bear flag pattern, but can patterns fail? All the time. It happens all the time. So before you get all caught up in the dollar index breaking down, breaks the 200-day moving average, you got a bear flag. Make sure you're focusing on the bond market as well, making sure that yields are following lower. That means the bond market is going higher as a result. All right, let's take a look at some of the other currencies that I think should be on your radar. As we were, let's talk about the euro. So the euro's got that, it's the inverse of the dollar index. So you got, a bull flag pattern trying to develop. You're trying to break above the 200-day moving average. And to be honest, that euro looks pretty bullish. It does. And if we get above, let's call it 105, that's going to be a very bullish event for for the euro. Now, we do have Eurozone CPI coming out on Wednesday. Could that be the catalyst that drives the market higher? You know, if the Eurozone CPI that's expected to come in around 10.4% year over year, if that comes in a little bit hotter than expected, could that be the catalyst that drives the euro higher? It could be. I mean, there's so much other data that's happening this week between all the jobs data. You got preliminary GDP for the U.S. You got JOLTS jobs openings. You got Fed Chairman Powell. He's speaking. I'm sure you got other. Let me look around really quick. Yeah, we got a couple other FOMC members that are speaking. So there's a lot of things and we have PCE data coming in on Thursday, and then the jobs report on Friday. So there's a lot that could actually drive the dollar this week. But I think the setups right now are pretty clear for further dollar weakness. But what are we going to be looking at just to confirm that the dollar weakness is real? The bond market, right? You're going to want to confirm it with the bond market. You're also going to want to confirm it with gold. And I'm going to talk about gold here at the very end. But before I move along into different currencies, I just want to say, if you guys like these videos, you like these week ahead videos, make sure you give us a thumbs up. If you have some comments down below, comment. And, if you have any setups that you're seeing that I didn't see, please feel free to chime in. I'd love to hear what you have to say, and I'm sure others would too. Let's take a look at the sterling. You notice that sterling's at the 200-day moving average, or nearing the 200-day moving average. We talked about this, bullish triangle developing. A move above 120 is bullish, and guess what? While we're above 120, yeah, I would hate to be a bear in the sterling. You get back below 120 though, that would make me a little nervous. Now, also on Tuesday, for those of you trading the sterling, I'm long, just so you know, from last week. If you're trading the sterling, Bank of England's Governor Bailey is also speaking Tuesday morning. So in morning New York, so it's later in the afternoon in UK time. So just keep that in mind. But the sterling looks quite bullish. Take a look at the Aussie. The Aussie still has this inverted head and shoulder pattern that has a little bit of distance before we complete. Once we get towards 69 cents or that 200-day moving average, it's around 69.30. I think that's where you got to be a little nervous. Now, mirror the Aussie move with the S&P move, and you're going to see a very similar move. So as the S&P gets towards the 200-day moving average, I'm assuming that the Aussie is going to be nearing that 200-day moving average. And that's where, again, you have to be a little careful. I think the easy money of playing the dollar to the short side has been made over the last couple of weeks. And if you've been listening to the week ahead video, hopefully you've been doing well. I know the Forex analytics traders have been doing well. And speaking of Forex analytics traders, hey, if you want to learn how to get involved in the Forex analytics community, check out the Trader Funding Program. The Trader Funding Program is a great way for you to be able to access larger amounts of money. You could also not want to risk your own money. You want to risk our money. Well, you don't take any of the risk. You make 75% of the returns once you pass an assessment. So if you want to figure out how to take an assessment, make sure that you watch the 2-minute video right here on the Trader Funding Program site. You can also find the link in the description. This last week, we talked about it on the Face show and the Morning Edge. We authorized a 5-figure payout to one of our traders this week. It was really nice. It's nice to see that. And I want to say congratulations to that one trader, if you know who I am talking about. But we authorize payments every week, but that one was a pretty sizable one. So that's great, because not only is he making money, but also, as the prop firm ourselves, we get to capitalize on that as well. And we keep 25% of that. You guys keep 75%, which is a huge payout. All right, let's continue on to back over to the markets. Let me go back over to the dashboard here. Let's go over to the Kiwi. The Kiwi, very tight consolidation. We talked about, if you were listening to the Face show, we talked about this very tight consolidation in the Kiwi. Following the RBNZ, the Kiwi actually rallied, and we're attacking that 200-day moving average, as you can see that. Now, that is a huge level of resistance for the Kiwi, so that's just something to keep in mind. The dollar Canadian, we talked about last week. If you go to the week ahead video from last week, we talked about this neckline being a very important neckline. Well, I hope you guys had an opportunity to sell it at 135 because that was the neckline. And I think we went to 134.90 something, if I'm not mistaken. Let me double check that. The high was 134.95. So 5 pips shy of that neckline. And then we just reversed as we talked about it this last week. I think while that's still in play, you've got to keep an eye on dollar Canadian downside. Now, one of the other things that you got to pay attention to when you're trading the dollar CAD is you got to pay attention to the you have crude oil, and crude oil actually looks pretty damn weak, and that's something that that as crude oil continues to weaken, that's not going to help the dollar CAD lower. That tends to be the asset class right now that is keeping the dollar Canadian elevated at this point. One of the thing I wanted to talk about, and I mentioned I was going to talk to you guys about this, was gold. Last week we talked, and this is the drawing that you guys and gals probably remember from last week. We talked about gold pulling back. It didn't pull back as far as I thought it was going to, and it doesn't mean it won't. I mean, look, if the dollar continues to rally and it bounces, and we don't get that sell off that we were looking at with the dollar index, and we get that bounce, well, maybe that would be the catalyst that drives gold down here towards the neckline. But right now, I think what we have to pay attention to is really, really key, and resistance is holding with gold. And I think a break back above the 200-day moving average or back above this resistance here would be quite bullish, no matter how you're looking at gold, whether it ends up being an inverted head and shoulder pattern, whether it just ends up being some sort of triangle consolidation, some sort of bullish consolidation before we move higher. However it ends up developing, I think we have all come to the conclusion that there's very critical resistance here in the gold market right around this, you can call it around 1800, because that's about where the 200-day moving average is at, really close to that 1800 level. And I think that's going to be very critical on any rally. One thing I guess I should mention is Bitcoin. It's still trading really heavy, even though we've had this rally in risk. Okay, let's just add really quick the S&P. Okay, let's just add that as a separate scale right there. Even though we've seen this rally in the S&P in recent weeks, you can see that rally right here in recent weeks, Bitcoin still looks like, poop on a stick. Best way I could describe Bitcoin at this moment. Well, what happens if the S&P, which is in teal here, we hit that channel resistance, which you guys all know I was showing you on the other chart. We hit that channel resistance and we roll over. Well, what do you think happens to Bitcoin? Well, I think if you were Michael Saylor, you'd be pretty worried. And if you happen to be buying cryptocurrency because you think it's it's cheap or inexpensive at this point, remember, it could become more inexpensive too. So make sure you keep your stops in place, and where your risk is at all times when you're trading these cryptocurrencies, which is an asset that is, vigorously over the last several years have been trying to prove itself as an asset class. And we'll see if it can do so in the future. But guys and gals, I want to say thank you so much for tuning in this week. Good luck for the jobs report on Friday. Remember, we cover analysis live, not just with myself, but with the rest of the team every single day on the Face Show. And we also have the Flow Show. For those of you that are European traders, make sure you're tuning in to listen to Ryan and his crew early in the morning. Well, I'm asleep, but early in European hours, so you can get set up for the trading session. So guys and gals, my name is Blake Morrow. Thanks for spending your time with me. I'll see you on Monday morning. Hey traders, this is Blake Morrow with Forex Analytics. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.